Hello, it's Rhonda Thomas, and we're just about to start Managerial Accounting, Chapter 7's coursework. The video for the intro work I just did, so you can go back and look at that if you need help with any of that. But we're going to go on to the coursework so that I have a video to help you with. So in Chapter 6, we were learning cost, volume, profit analysis. So now we're going to take some of the concepts that we learned in that and put it into what's called variable costing and absorption costing. Okay, so I'm on number 1 here, 7.2 right here. Okay, so we've got absorption costing. I just want to bring this to your attention. So let me make this a little bit bigger, hopefully, so you can see it. So here's what we're talking about. Notice that here's what we have been doing, right? We have been taking sales minus cost of goods sold equals gross profit. And then we normally subtract the selling and the admin, and we come up with an operating income. Well, we're going to expand it out a little bit and break up the costs that vary with what you're selling and the fixed. Okay, so here's a new way of separating our income statement. We're going to start with sales. Then we're only going to pull the variable cost of goods sold. Okay, so any fixed amounts, which would be like fixed manufacturing overhead, is going to get pulled down to here. Okay, so we've got a little bit of a different calculation now. So we're going to subtract the variable cost of goods sold, and we come up to a new subtotal. This new subtotal is called manufacturing margin. And then we're going to subtract any variable selling in admin. Okay, because once again, variable has to do with how many you sell, right? Usually the variable amount is based on production or sales. And then we'll bring in, after that, we'll have a contribution margin. Okay, and then we'll list any of the fixed costs and come up with a total, and then subtract the total fixed costs from contribution margin to get operating income. Now, some of these may be a little different. Okay, and here's something that I want to make sure you see the rules about. Okay, so up to now, we've done this one. Okay, hang on just a minute. I'm going to move this down. Okay, so up to now, we have sold what we produced. Does everybody see this? Okay, up to now, however many we produced, that's in manufacturing, we have sold them. Okay, we've sold them all. Well, and that's where we get this absorption costing right here. Okay, but when that changes, so for example, if we produce more than we sell, okay, then there's going to be something called variable costing income. Variable costing income will be smaller than absorption costing income. So these are rules that if it were me, I would write them down, okay, and commit them to memory so that if you get asked a question about this, so when they equal each other, this variable costing income equals the absorption costing income. But now we're going to make them different. And when we do, when production has a bigger amount of units than sales, then the variable costing income is smaller than absorption. But then the opposite is true. If the sales units are bigger amounts than the production units, then variable costing is bigger. So production is manufacturing, right? Yep, it's manufacturing. And just because you manufactured X amount of them doesn't mean you sell all of them, right? Along with it, okay? So however you want to memorize that, I'll try to help remind you of that as we go through this, okay? I remember trying to remember these rules. And it could be a little bit challenging, that's for sure. Okay, let's get started. We're going to start putting together some income statements, okay? Because when we do these income statements based on either absorption or variable, you might get different answers, okay? So, one more time, here's what absorption means in this book. If you see the word absorption, the reporting of the costs of manufactured products, normally direct materials, direct labor, and manufacturing overhead. Okay? And that includes fixed costs in the overhead. But if you look at variable costing, this concept considers the cost of products manufactured to be composed only of those manufacturing costs that increase or decrease as the volume of the production rises or falls. So, yes, you would still have direct materials, direct labor, but when it comes to the manufacturing overhead, you're going to only include whatever is variable. You're going to leave the fixed down below after the contribution margin, all right? So let's put together an income statement like we have been doing under the absorption costing income, all right? So up here, we have $1 million worth of sales, okay? So I'm going to put this in, and by the way, this is the Crazy Mountain Sports. They assemble and sell snowmobile engines. The company began operations on March 1st and operated at 100% capacity for the first month. So I put that here, okay? You do need to watch for capacity a little bit because some decisions made in managerial accounting will only be made if there's some room in the capacity. If they're already operating at capacity, you don't have as many choices, okay? So we don't have to really concern ourselves with the capacity for this chapter, but we might soon, okay? So here's what I'd like you to do. Let's just put together this income statement, right? So I've got sales of $1 million and I'm selling 10,000 units. Okay, so I'm putting that in. Okay, and now look what it says. Look right here. Let me make this bigger. Notice we're selling 10,000 units, but we produced 13,000 units. Everyone see that? Okay, so we've got some difference in our numbers, right? So if you go back and look at the rules that I was telling you about, when units sold is smaller than the units that we produce, right? So if sales are smaller, then what's going to happen? Variable costing income is going to be smaller than absorption, okay? So I'd like for you to be able to find that, and then, so based on this information here, variable costing, so I'm just going to put it right below here. Variable costing income will be smaller than, okay, smaller than absorption costing income. Okay. So when we get finished, we're going to put together an absorption costing income statement. So it should have a bigger income than when we put together the variable one. right beside it, okay? So back up here to what I was talking about. Okay, so the cost of goods sold. Okay, we've got cost of goods sold is right here for absorption. Okay, so I'm gonna put 904,800. Okay. So let's start putting this in. The sales go at the top for $1 million. You put your numbers in, and then the cost of the goods sold is everything you see here. The 904,800, that would include direct materials, direct labor, variable overhead, and fixed. Okay, right now we're doing absorption. So if you do absorption, you leave the fixed manufacturing overhead up here in production costs. And then you have your selling and admin down below. So this is what your cost of goods sold should be when you're putting in this information. All right, so we're going to put in 904,800. Okay, and okay, so I'm going to go ahead and put this in as well. So it's $1 million of sales. Once again, 10,000 units sold, 13,000 produced. Okay, and the cost of the cost of goods sold is the whole amount. Okay, so then the gross profit, you just subtract your cost of goods sold from your sales, and you'll have a gross profit that shouldn't be too far from what you're used to seeing. Here are our total selling and admin, both variable and fixed, but in the absorption costing method, we leave fixed wherever we've had them before. Okay, so we're going to put selling and admin, and then this is going to be 194,500. Okay, and so let me put this in 194,500, and then we should have operating income. Okay, so let me also put this in 904,800. Okay, so this is just a different way of putting together information, because the thing about fixed costs is they don't change, right? They're fixed. So when they're fixed, they don't have as much impact on decision making as variable does. Okay, so we have an operating income when we subtract. Okay, so let me change this. So when we try. Okay, so selling and admin. Okay, 1, 4. Okay, gross profit. Let's see what's going on. Okay, so once again, our units produced is more than our sold. So variable costing income will be smaller than absorption. So that's what we can expect. Okay, I am going to put okay, so we see here, we got gross profit, selling and admin, selling and admin. Okay, let me see. I think I'm on the right track. Last I knew I was. Uh-oh, hold on. Okay, no. Okay, so let me see. I didn't think that was. All right, so let me see here. Okay. That's all of that. Okay, this is produced. Okay, so okay, so this is broken up into, okay, so the cost of the goods that we sold. All right, so we only sold 10,000 of the items, right? We only sold 10,000 of the 13,000 that was produced. So we need to get this down to how many it should be. All right, so let me get this in here. Go ahead and put your labels in. Sales, cost of goods sold, gross profit. Then we subtract the selling and admin, and operating income is what we'll end up with. Okay, then if you want to take just a moment and put in the new uh, variable costing income statement, it starts with sales also. Okay, so it's going to have the same amount of sales. Sales doesn't change. Okay, so we have $1 million worth of sales. We sold 10,000 units. Okay, so let me put this in. Okay, and that was our 10,000 units. Okay, now where that number is coming from. Okay, so then you can put in variable costs, variable cost of goods sold. Then we're going to have a new subtotal called manufacturing margin. Then we're going to put in the variable selling and admin, and then we will get our contribution margin. Then we'll put our fixed costs in, fixed manufacturing overhead, and fixed selling and admin. Then we'll have a total fixed, and then we'll subtract those fixed, and hopefully we'll have an operating income. So I just kind of want to get you used to this pattern of what we're going to be doing here. Okay, so now let me see if I can figure out what I'm doing wrong up here. So, okay, the reporting of the costs of manufactured products, normally direct materials, direct labor, manufacturing overhead, and product costs. Okay, let me make sure that this is adding up for what we need to here. Okay, so that doesn't. Okay, the selling and the admin is still good. Okay, so let me go to the, I'm gonna go to the book too, so that we can see a little bit here. Because when we're doing these different income statements, we have to make sure that we understand how it's gonna work. Okay. Okay. Okay, we're making 13,000. Okay. So we're selling 10,000. Okay. So this was enough. So what's going to happen here is if we produce 13,000 units, but we only sell 10,000, we're actually going to have some inventory left over in finished goods. Okay, so not all of this is going to be cost of goods sold as we thought. All right, so let me see if I can. All right, so if this is the cost of goods sold of 13,000 units, let's see what 10,000 units would be. All right, so I'm gonna take, and I'm gonna show you the calculation next door to it. Okay, we're gonna take 904,800 divided by 13,000 units produced. And now we're gonna get an amount per unit, okay, amount per unit. Okay, so we're gonna divide that. Okay, I got $70. Now let me make sure that we, okay, so then, okay, now let me try the 10,000 times that. So equals 10,000 units sold times set 6960. Okay, I'm gonna give this a try. I think, like I said, I did this yesterday, so I guess my brain is just not remembering all the steps. It's a little bit confusing, but we're gonna get there. So if I put that in, okay. So no, let me go back. Okay, so the fact that we're selling less than the produced, right? That means that once again, we have to adjust the cost of goods sold down to how many we actually did sell. So if we take the 10,000 units sold, and we're gonna take it times the 6960. Okay, so 10,000 units times this cost. Why is that doing that? Okay, doesn't like me do. Okay. All right, so let me try this one more time. Let me take this out of here. Okay. So let me do this one divided by 13,000. Okay, 6960, we're gonna take that times 10,000. Okay, 10,000 units times. Oops. Okay, so now let's try it. Oops. I want to be able to calculate this. Okay, so, okay, enter. Okay, and then we have 304. So now let me see. So what you have to do sometimes is if you produce more than you sell, you've got to come up with how much the cost of the goods that you sold. Okay, we didn't sell 13,000 units, we sold 10,000 units. So let me put this in here and make sure that it's working. Okay, so 69,600 subtracted 304,000, and then I'm coming down here to operating income of 109,500. If it's not right, then I'll figure it out. Okay, so let me see if I can help you. This, like I said, this can get a little bit challenging. So let's all see if we have the same scenario going on. Okay, put the amount of your sales right here for the absorption costing. Do you all have a smaller number in sales than you do produce? So you say, where are we finding that? When you look here, how many units are you selling? Can anybody tell me? This is on the very first problem, right here.
17,000.
Okay, so you're selling 17,000. How many are you producing?
23,000.
Okay, so I believe all of us have smaller sales units than we do production, okay? So what you have to do, we are selling 10,000 units, but when it comes to the cost of the goods that we're selling, we have to remember that we're only selling 10,000 units, where this is the cost of 13,000 units. So what you need to do is go ahead and put however much your sales are, whatever that's showing, put that here and put it here. Okay? Because that's going to at least give you your sales. You do start with the same number of sales. Okay? But then what you have to do is you have to take, this is your cost of goods sold right here. Here's your direct materials, your direct labor, your varying manufacturing overhead, and your fixed. If you add all those together, here is the total. But that is for 13,000 units. So you need to take this cost of goods sold and divide by the 13,000 units. That's where I got this here number that is the 6960, and I took that times 10,000 units to get my cost of goods sold here in the absorption costing income statement. So here's how it's going to look. So 10,000 units times that 6960 cost, right, is how we're getting this number here. So you said 10, you did 17,000. You would just need to find out how much your cost is per unit when you're looking at your cost of goods sold. So whatever's sitting here in your problem, divide that number by how many you produced. Okay, how many you produced. So you can get the cost of goods sold based on produced amount. Okay, so that's how we're getting the cost of goods sold for 10,000 units. Okay, 10,000 units. Okay, so I want to make sure that we're only selling 10,000 units. So we've got to adjust the cost of goods sold. We've got to adjust it down to 10,000 units, not 13,000 units. If you try to put 904,800 there, you end up with an operating loss. Okay, you end up with an operating loss. So this might be a little harder to do, I understand. So then you're selling in your admin, you take all of it, okay? After you have subtracted however many you sold times the cost of each unit, then you're going to have a gross profit. Then you're going to subtract your selling and admin expenses, and then you come to an operating income. Okay. So, does anybody need help with that? Okay, you got it. I'm not surprised. You guys are pretty good at this. Okay, now we're going to take the same information and break it up into what's called variable costing. Okay, so this was absorption. Okay, so here is variable costing. All right, so I've got to put just the variable costs from the cost of goods sold here. So the costs that vary based on the number that you produce or the number that you sell is direct materials, direct labor, and variable manufacturing overhead. So we only want those three, and we're going to add those together. Okay, so I'm going to put them over here for me. And I'm going to leave off your fixed manufactured overhead. Now I've got 828,100 as the cost of production. Okay, and I'm going to divide that by the number we produced. Okay, so mine is 13,000. So I get 63.70 per unit. So this is variable cost per unit. Okay, and now I'm going to use that here for my variable cost of goods sold. Okay, so one more time, we're selling 10,000 units, but we produced, okay, so we produced 13,000 units, I already did that, but we're selling them. So 10,000 units. So let me see if I'm on the right track here. So 10,000 times, okay, so okay, so we want the number sold. Okay, 10,000 times, so we should have 637. So the cost of goods sold is going to be lower because you're leaving out fixed manufacturing overhead, okay? So if you have cost of goods sold up here, it has the fixed manufacturing overhead. Down here, this one does not. It only has the variable. So once again, when you add up your direct materials, your direct labor, and just your variable manufacturing overhead, okay, here's the total that I'm getting. And then I'm going to divide that because we produced 13,000. So I'm going to put that beside here to remember that. So this gets us down to $63.70 per unit. And now when we put together the income statement just with variable costing, same amount of sales goes at the top, but not the same amount of cost of goods. The same amount of cost of goods, we're only going to be looking at the variable. So if we're selling 10,000 units, we're going to take that times that cost that we just found of 63.70. Okay, so I'm putting this in here so you can see the 63.70. Okay, so that you can see why that number, where that number is getting calculated. My new subtotal. Okay, so when you subtract your variable cost of goods sold from your sales, you get a new subtotal called manufacturing margin. So 363,000. Okay, now the next one is just the variable selling and admin. Okay, so if you go back up here and look, the variable selling and admin is, mine is 140,200. So I'm going to put that in 140,200 because all we want is the variable costs, variable only, to get us to what's called our contribution margin. Okay, contribution margin. So here should be what mine is. Okay, yeah, manufacturing margin. Okay, variable manufacturing margin. Then we want, okay, manufacturing margin, 140,200. And now we're down to contribution margin. So when we were working in chapter 6, we didn't have the differences between the number produced and the number sold. Okay, so it didn't matter. But now that we do have a change, we need to understand how looking at two different income statements can help tell you more information. All right, so I'm looking at, if you subtract this variable selling and admin from the manufacturing margin, it is 222,800 is my new contribution margin under the variable costing. Okay, and then you just go get the fixed costs that are in the problem. We have a fixed manufacturing and a fixed selling and admin. Okay, so here's your fixed 76,700. So I'm going to put this in. And my fixed selling and admin is 54,300. You add those two together. Okay, you add those two together and you get your total fixed costs of 131,000. Okay. And now you have a different operating income. So when you subtract your total fixed from your contribution margin, you get what's left over as your operating income. Okay, so let's see if this held true. We said the rule is when you produce more than you sell, then variable income will be lower than absorption income, right? Absorption income is 109,500. Variable income is 91,800. So that is holding true. Okay, yes. So I'll highlight my two numbers that I wanted to make sure that I looked at to see if the rule held true, right? Okay, so you're going to have to pay attention to how many you sell versus how many you produce and so forth, okay? So let's see if we can understand what's going on here. So what is the reason for the difference in the amount of operating income from our absorption costing income statement versus our variable costing income statement? So under the absorption method, the fixed manufacturing cost is included in the cost of goods sold, is matched with the revenues, okay? But under the variable costing, all of the manufacturing cost is deducted in the period in which it incurred, regardless of the amount of inventory change. Thus, when inventory increases, the absorption income statement will have a higher operating income. All right, this is some challenging stuff. Okay, so please try not to get too worked up over it. I'll be glad to help you understand as much of it as I can. Okay, but once again, we're moving some of the fixed overhead product costs out of cost of goods and putting it down into what's called period costs, okay? Because period costs before Chapter 7 were all selling and admin, but now we're putting some fixed manufacturing costs down in the category of the period costs, okay? So let's just try to, I feel like I should be explaining more and more and more. But let's see what we can do with another problem. Okay, if you need help and you're not getting your answers, let me know. Okay, I will take a minute and help you out. Okay, so I'm going to go on to number 2 now. And this is to do some estimates. To do estimates. So we know estimates tend to be a guess, right? Tend to be a guess. All right, so we're going to make an absorption costing income statement and a variable income statement. And we're going to use 2 different amounts for the number we produce. Okay, so let's go ahead and read through this. And we're going to start with the absorption costing income statement. Let's see what's going on. So this is the first month of operations, and we're ending it on January 31st. Okay, so I do want to put that this is the month of January. Okay, so this is the first month of business in January. Okay. And here is our sales. Okay, now just remember, sales do not change. Only the costs change between the different income statements. So we're going to sell 15,200 units at $53 a piece. okay? So the first column that we're putting in here is we're gonna sell what we produce, okay? We're gonna sell what we produce because we're producing 15,200 units and we're also selling it, okay? And they're telling us how much the sales will be, all right? So let's put in sales, cost of goods sold, okay, is the cost of goods manufactured. Okay, so this is gonna be, I'm sorry, hang on. This is gonna be cost of goods sold. Okay. Right. Direct materials, direct labor. Okay, so this is gonna be all of the, all right, so let's go ahead and put the amount of sales. So I got 805,600 for mine. Okay. And we'll come back to this one that's talking about 16,800 here in a minute. Let's go ahead and read a little bit more. So if this is their first month of operations, this is how many they're selling, and this is how many they're producing. So if we have direct materials, okay, so I need to put in direct materials, direct labor, okay, so this is going to be for absorption. This is manufacturing overhead and fixed manufacturing overhead. So this is our cost of goods manufactured. Okay, so how do they want us to put this in? So they want this to be cost of goods sold. Okay, so we're going to make up a cost of goods sold and get it to total cost of goods sold. Okay. And then we're going to get to gross profit. And then we're going to subtract selling and admin. And then we're going to end up with hopefully operating income. Okay. So we're also going to put another label here. So to come to our cost of goods sold, we're going to figure our cost of goods manufactured. So if you look at cost of goods manufactured, that's the direct materials, the direct labor, and the manufacturing overhead that comes into that WIP account, okay? And then this one is going to be your inventory at the end of the month, okay? So when we sell what we produce, we don't have anything in inventory in finished goods, okay? So put your 0 there for when we produce the number that we sell, okay? For the cost of the goods that you manufactured, you'll want to add up how many direct materials, direct labor, variable overhead, and fixed manufacturing overhead. Add those 4 amounts together. Okay. And 63,840. Okay. So here is my cost of goods manufactured. Cost of goods manufactured for the 15,200 produced and sold is pretty much just like what we've been used to doing. We have all of those there. So if you add up these first 4, you should get the answer for your cost of goods manufactured. Okay. Okay. And then we're going to get we're going to get our total cost of goods sold. So there's nothing to add to the goods, cost of goods manufactured. So you just bring it down. Okay. Now we're going to get a gross profit. Okay, a gross profit. So a gross profit is subtracting the cost of goods manufactured from sales. Okay, cost of goods manufactured or the cost of goods sold. Let me change this. So it's actually 51. Yeah. So your gross profit is going to be the cost of goods you just figured from your sales. Okay, so that's 88,160. And then we're going to put in our selling and admin. Okay, so selling and admin expenses. Okay, is 38,400. Okay, so let me see. Yeah, so you add these two together. Okay, where is that? Over here. No. Okay. So let me put these in. Okay, so this is going to be 17,400 plus 21,000. Okay, so you have to add those together to get 38,400, and then you subtract that from the gross profit to get an operating income. Okay, so here we go, 38,400, selling and admin. We're gonna subtract that from the gross profit to get 49,760. Okay, so let's see if we can all get our first absorption where we're selling the number we produced. Okay, because things are gonna change here just a little bit. Okay. All right. So now we're gonna do, let's go ahead and do variable. Let's just keep going with producing and selling the same number. Okay, so let's just go ahead and come on down here and keep doing the variable costing based on the 15,200 units manufactured and sold. So let's put our sales. That has not changed. Okay, that has not changed. It's whatever your problem is telling you. So the variable cost of goods sold, however, are just the three variable costs: direct materials, direct labor, and variable manufacturing overhead. So I need to make sure that these are in here. So I've got 484,880, 115,520, and 53,200. That's where the cost of the goods manufactured stops. Okay, there is no fixed in the variable. Okay, so here's how much those three items cost. So we're going to put that in. Okay, so cost of goods, the variable cost of goods manufactured, that's what that is. Okay, so all right, so this number should be 653,600. Okay, we don't have any in ending inventory, so zero. Nothing is in ending inventory because we're selling what we produce. And now we add these two together to get your total variable cost of goods sold. Okay, total variable cost of goods sold. Then I need to check my work. Okay, so let's see if I'm missing anything, because like I said, this is a little bit new to me. This is a different concept than I've taught much before. All right. So now what comes in down here after we put in our variable is, okay, so this is the variable cost of goods sold. Then we have a manufacturing margin. Manufacturing margin, okay? Manufacturing margin takes your variable cost of goods sold and subtracts it from your sales, okay? So you're going to take whatever number you got here and subtract it from your sales so that you get manufacturing margin. Okay, that's whatever manufacturing margin. And I've got to hit enter over here for mine to produce. So there's my manufacturing margin. I'm down to 152,000. Okay, and then we're going to subtract our variable selling and admin, variable selling and admin of 21,000. So if you go back up here and look, your variable selling and admin, whatever that is, let's put that in. Okay, then we're going to subtract that from at manufacturing margin to get our contribution margin. Okay, so I've got 131,000 as my contribution margin, 131,000. Okay, we're now ready to put in our fixed costs. We have two different sets of fixed costs. We got fixed manufactured overhead. We got fixed selling and admin. So pick fixed manufactured overhead and fixed selling and admin and go get the numbers. Okay, so up here in the problem, I've got 63,840, and I've got fixed selling and administrative expenses of 17,400. I'm going to add those together, and then I'm going to subtract that total fixed from the contribution margin, which then will give us operating income. Okay, so our fixed manufacturing overhead, fixed selling and admin, we're going to add those two numbers together, and then we're going to subtract that from the contribution margin. 49,760 is my operating income based on producing the same amount that we're selling. You agree with that? Remember, we're selling what we're producing, right? Look what's going on. Your operating income should agree. It should agree with the operating income we found for both of those. Okay? So it's it's pretty much trying to provide evidence that this is what's happening. Okay? Now we're ready to do where we actually manufacture more than we sell. Okay? So I want to read what this says now. Okay? The company is evaluating a proposal to manufacture 16,800 units instead of 15,200 units, thus creating an ending inventory of 1,600 units. So when we do this new unit produced, we're producing 1,600 more. Here's the information you need. Manufacturing the additional units will not change the sales. It will not change unit variable manufacturing overhead costs. It will not change total fixed manufacturing overhead costs or total selling and administrative expenses. Okay, so we're going to have to try to remember that as we go through this. Okay, so here's what I did. I created a column that says how many we're producing, okay, versus how many we're selling. And remember, we're going to have an extra 1,600 units left over for ending inventory. So you'll want to figure that, right? Your problem should tell you that if you produce 16,800 units and subtract 15,200 that you sold, you should have whatever your problem is saying here as the number of units in ending inventory. Okay, so let's keep that in mind. So they said producing these extra units will not change our sales. So whatever you have for sales, put that amount in. Okay, put that amount in because producing these extras is not going to affect the sales. It's only gonna affect the manufacturing part. So go down to your other one and put that same amount in. Okay, it does not affect the sales. Okay? All right, so now we have to come up with, now remember, this is manufacturing here, right? And this is how many we're gonna manufacture. So let's read what it says again. All right, so here's where I'm at. What we need to do is put in the amount of direct materials from what we produced, right? So if we produce direct materials, if we need to take that number, here's the direct materials when we did 15,200. This is the new cost, okay? The new cost when we divided it by 15,200. Now we're going to take that times the new amount produced, okay? So let me see if I can help you understand one more time. Here's the direct materials for producing 15,200 units. That comes down to $31.90 for a direct material. And then now that we're producing 16,800, we have to ramp that up. So we've got to take $31.90 times 16,800. And I have a new manufacturing amount. So I'm going to highlight the things that will change. Okay, the things that will change because it matters how many. So these I'm going to color these to show that they're going to have a different amount in production because we're producing more than we did here. Okay, so these three numbers are going to be ramped up based on the extra units. Okay, but you've got to find, so you could just add these three together. You could do that too. You could add these three together and divide by 15,200. Okay, but I broke it out into direct materials, direct labor, and manufacturing overhead. The fixed will not change. Okay, so I'm going to put in here what does not change. Okay, the fixed does not change. Okay. So this is, and this is absorption. Okay, this is absorption. So we're still working on absorption. So the fixed stay the same. These are the variables, but you've got to change the number of direct materials because we're making more units. When you make more units, it's going to cost more. Okay, so one more time, I'm going to make this show how much a unit is, and I'm going to show the math right here beside this. Okay, so the math is the number of produced units times how much direct materials is per unit. So I'm taking 16,800 units times, and I have a direct materials amount of $31.90. Okay, so $31.90. That's how I'm getting this number. Okay, for direct labor, it's the same thing. 16,800 units times. Okay, and then I've got to go look at what I have over here. Because if I take the direct labor and divide by the number produced, I get $7.60 per unit. Now I'm going to take my new units produced times the total of $7.60 to get this number. And then finally, 16,800 times And then that variable amount is $350 a piece. Okay, but that has to be times the new number produced. Okay, so I'm just gonna double check that this should be right. All right, so when we get to our cost of goods manufactured, that's what we're trying to get to. This amount right here. Okay, this amount right here. So we had to change these three. So we have new direct materials, new direct labor, new variable overhead, but the fixed doesn't change. So when you add these together, your cost of goods manufactured should be a new total. So 786,240. And now we've got to find the value of the extra 1,600 units, okay? The extra 1,600 units that we have sitting in ending inventory, okay? Sitting in ending inventory. So here's how we find it out. So ending inventory, I got 4680. So what we did was I took the costs of direct materials, direct labor, variable manufacturing, and then however much the fixed manufacturing overhead would be, and it adds up. So let me show you how I did this. Equals, okay, direct materials of 3190 plus, okay, then 760 plus 350 and then 380. Okay, so you have to figure out how much they are per unit. Okay, so my 3190 is my direct materials per unit. My $7.60 is direct labor per unit. And my 350 is the variable manufacturing overhead per unit. And then I have to figure out how much my fixed overhead is, which mine is $3.80. Okay, so fixed overhead, which we don't hardly ever do this per unit. So you're gonna have four amounts. Oops. So if you add these together, do you want to accept this correction? Okay. Okay, so I'm just trying to show you this in the, so let me put this in here so you can see it, okay? So that's all four of these per unit. And how I got this number is I took the fixed divided by the number produced, okay? So now, if you had any troubles with that, 63,840 divided by the number produced. And that's how I got the new fixed amount. Okay, and I just want that to show here so you can see it beside. That's how I got this number so that I could add up each of these. When I add up all of these, I get 4680. And then I need to take that times the 1,600 units that are still in inventory. Okay, so figure out our product costs based on including the fixed, okay, times however many units are in ending inventory. And we're going to add that to the cost. So that goes here because we had zero here because we sold what we produced. Now that we're producing more than we sell, we still have some left over in inventory. Okay, so 74,880 goes there. You add down. Okay, you add down Let me make sure I'm putting in my figures right. No, you subtract. Oh my gosh. Okay, you have to subtract this. So let me make this a different color because we're going along here thinking we add. This ending inventory has to be subtracted from the cost of the goods manufactured to get to total cost of goods sold. It's going to be smaller, okay? It's going to be a smaller amount. So total cost of goods sold, because we're selling less than we're producing, okay? Now we're going to get to a gross profit. Now we're going to get to a gross profit. So the gross profit is the total cost of goods sold from the sales. My gross profit is right here. Okay, so 94,240. And then you put in the selling and the admin, which that does not change. So whatever's sitting here in selling and admin, it goes in. Are you heading out?
I have to, sorry.
You what?
I have to head out, sorry.
Okay, I'm sorry, my voice isn't very good. So, I'm gonna go ahead and keep making the video, so if you need help, you can tune in, okay? So now, we're gonna subtract the selling and the admin from the gross profit to get an operating income, okay? The operating income is going to be more because this is absorption. The fixed costs are still in the cost of goods sold, okay? All right, so 55,840, I believe should be my answer. Okay. Now let's go down here and do this variable one. Now, this might surprise you. It might very well surprise you. So here's the thing. We're down here, sales are the same, okay? We've got to come up with the cost of goods manufactured. Remember, now that we're doing variable only, we've got to figure out, so the 3190 still holds true. So the amount that we came up here still holds true, except for the variable. Okay, so actually, these three numbers repeat right here, okay? So this is good news. Yes, these three numbers repeat. Even though we produced more, okay? Even though we produced more, these numbers stay the same here, okay? And so you add these three amounts to get 722,400. So here I am ready to put in my cost of goods manufactured, variable cost of goods manufactured. So I want to put that in here. Variable cost of goods manufactured. Okay, so let me put V in front of this. Variable cost of goods manufactured. That is all three of these and no fixed. Okay, so I'm going to put 722,400, and then I'm going to have to come up with the amount of the 1,600 that are still in inventory. Okay, so we're going to add up all four of those again, just like we did up here, but we're going to leave out fixed. Okay, leave out fixed, so we need an amount. So I'm going to put this beside it so you know how much this is. Okay, so this is going to be your direct materials, right? So 3190 plus, and I'm doing this to show how much it is. Okay, so let me take that off. Okay, so 3190 plus $7.60 for direct labor plus the variable overhead, which is $3.50, and you stop. You do not include the extra $3.80. So that's the difference between these two numbers. Okay, so this one is $43 a unit for the manufacturing costs. We take that times 1,600 and we put that amount in, and we're gonna subtract that from the cost of good, the variable cost of goods sold. Okay, the variable cost of goods manufactured. Okay, because we've got to take that out of there. Okay, so we're gonna subtract this, and we're down to the same number. Look at this. We're down to the same number as we did because we're just looking at variable costs up here, right? Yeah. So our manufacturing margin is the same, 152,000. The variable selling is the same. Okay. And we subtract, so we get 131,000 as our contribution margin. So that stays the same, and so does the rest. So when we take out the fixed and get them out of the manufacturing, you can see that you end up with pretty much the same operating income if you produce more than you sell. Okay, so I'm just going to go ahead and finish putting these in. So you just follow what your problem says, add up your fixed costs, okay, and your operating income, because we're using variable costing, ends up the same because it takes out those fixed costs. These fixed costs up here is what makes the difference between these two. But down here, when they're removed, we get the same amount of operating income. Now, let's see if we can't figure out the explanation of this. So what is the reason for the difference in operating income reported for the two levels of production by the absorption costing income statement? So if you look back up there, you'll see that absorption costing is caused, the increase is caused by the allocation of the fixed manufacturing overhead over a larger number of units. Okay, larger number of units. That's true. Thus, the cost of goods sold is more than when you don't have that in there. The difference can also be explained by the amount of fixed manufacturing overhead included in the ending inventory. Whoop, sorry. I just did wrong. Okay, so sorry. Thus, the cost of goods sold is less. Yes.
Can you scroll up when you get a chance?
Yep.
Yeah, right there.
Yep. So,
Missing some stuff.
okay. And this actually doing this, I know it, I was a little bit caught off guard about how some of this is. So, but the idea is, even though we're manufacturing different amounts, because we're removing the fixed costs, we end up with the same operating income, okay? But when the fixed costs are left in the production or the manufacturing costs, then you get different income because of that fixed income being spread out over different amount of units, okay? So I think this would be better side by side if you could see it better.
How do you get the manufacturing margin again?
Okay, so manufacturing margin is calculated by taking your total variable costs from your sales.
Oh, okay.
That's okay.
Okay,
No,
thank you.
no, ask away. I'll do the best I can. Because like I said, this is kind of a new concept for me to teach. And I'm like, wow, this is quite a bit. Okay, so we're going to just take it as it comes, try to make sure we can, but if you'll memorize these rules up here, right? So if you look at, if this is absorption, and once again, when we sell what we produce, we don't have a difference, right? When we sell what we produce, which is this column, then our income is exactly the same, right? Yep, we sell what we produce, our income is the same. It's also the same if we use variable costing and produce more. We still come down to the same amount of operating income, even when we're looking at variable costing. But the one that changes the amount of income is the absorption. When you have this amount of overhead that has to be divided by the number you're producing, okay, which was that extra $3.80, right? We had to add all four of these product costs together, and that's that extra amount, and that gets subtracted out. So the cost of the goods sold is actually lower, which is where I screwed up on that answer just a second ago. So when you take some of that fixed costs out, because they're still in ending inventory, they have not been sold yet, there is when your cost of goods sold actually is being reduced. When you reduce your cost of goods sold, guess what happens to your gross profit and your operating income? They go up. Yep. So I know. If you
I think I'm still missing it.
okay, so where are you at?
Yeah, right there.
Right here?
No, that bottom part.
This one?
Yeah, it's the
Okay,
manufacturing margin.
manufacturing margin. So do you have a number for total variable cost of goods sold
Yes,
for each one of those? They should be the same.
yes.
Okay, so now take that number from your sales. And then you'll have manufacturing margin.
Oh, okay,
Okay, yep.
okay, thank you.
Well, this would have been better if they would have moved over another column, right? So we could see when we get, so here's a new subtotal, right? This is a subtotal. Manufacturing margin, contribution margin is a subtotal. Okay? So then once you get your manufacturing margin, then you put in your variable selling and admin, and then you subtract to get your contribution margin.
Okay, thank you very much.
Sure. Any, just let me know if you need me to help you finish it out. Then, pretty much from that point on, everything's the same. In the variable costing income statement, no matter how many units you produce, okay? Because we have removed the fixed cost that makes the difference in the cost. So when you get down to the bottom, that's why you're getting the same operating income. I know. If it's okay, so one more time, if you need this again, the increase in operating income under absorption is caused by the allocation of the fixed manufacturing over the larger number of units that you're producing. Okay, thus the cost of goods sold is less. And we proved that, right? We looked up here and said, oh, our cost of goods sold here is less than when we were doing the same number of units produced as sold. But now we're going to do more produced than sold, and we have to subtract out, because this is where a lot of people forget. This has to be subtracted from your cost of goods manufactured. Because you still have I still have 1,600 units still in finished goods, okay? I still have 1,600 units still in finished goods, and I've got to subtract out that amount from the cost of goods manufactured, okay? Okay, do you feel like you can go on? Well, I give you guys props for that because this is rough. All right, I think things are gonna be a little better from here, but those two things, I'm not gonna test you very heavy, if at all, on that, because that stuff is, I mean, you really have to practice. Okay, now we're gonna do some variable and absorption costing over some products, okay? So, we make shoes and we make cross-training, golf and running shoes, all right? This is the income statement and this is absorption costing. So remember, absorption costing, you leave the fixed overhead in manufacturing, but they have to break it out some for us so we know what to pull out when we do the variable costing. Okay, so what I would recommend is if you wanted to make 3 columns, right? I've got the cross training, golf and running. Okay. Cross train, golf and running. All right, and I've got to change my numbers because this is a new problem from the one I did yesterday. So I'm just going to repeat what I've got going on here. Okay, so our revenue. So I'm going to put 510, 600, 306, 400, and running shoes. Okay, I'm just going to put the cost of goods sold, whatever it says, just repeating it. Okay, put that in. I've got a formula in there that subtracts the cost of goods sold from the revenue to get us down to gross profit. Okay, we're used to that. Okay, so just do the math for both of these or all 3 of these lines. And whatever you see here is what you should produce. I mean, we're just putting in the numbers so that we can manipulate them based on what this is telling us. Okay, so now I'm ready to put in my selling and admin. Okay, and that's going to go in. And I've got this in here as variable cost. Hold on just a minute. Oh, they want us to do variable. Okay, that's all right. That's fine. So hang on just a minute. So let me show you what we need to put in order to know how much. So let me go up here. Okay, I'm going to use what I see here. So the cost of goods sold. So what we need to do, so I tell you what, okay. Just leave your sales up there. Okay. If this is all of your cost of goods sold, what we're going to do is we're going to take this cost of goods sold and we're going to subtract out this fixed amount and put it there. Okay. So I'm going to put next to this cost of goods sold minus the fixed amount. Okay. Whatever it's telling you, fixed cost of goods sold. That's going to be our number here. So I'm going to say equals, I'm going to put 265,500 and I'm going to subtract 81,700. Okay, so let's give it a try. Subtract out the fixed out of my cost of goods sold. Okay, so you should get a little bit different number. But this number is up here to show you what the total is based on absorption, but to get it into the variable cost of goods sold, you have to subtract out that number for each one of these. All right. So now I'm going to go to golf. Golf is 150,100. I'm going to subtract out the fixed cost of goods sold, 39,800. Okay. So I'm just going to make that happen in my cell. got 150,100 and subtracting 39,800. So I got 110,300. That's the cost of the goods sold. Gonna do the same thing for running now. Okay, we'll take the cost of goods sold and subtract out the fixed amount. All right, so you should have different numbers than what you see here because this is getting subtracted from it. So then you should get what's called your manufacturing margin, okay? Because these are your variable cost of goods sold because we subtracted out the fixed, okay? So then you're getting a new subtotal that we're learning, revenues minus variable cost of goods sold equals a new subtotal called manufacturing margin. Okay, so that is going to be a new subtotal. Okay, so I'm going to go down here and I'm going to start putting this in. Okay, let's put in revenues. Let's start putting this in so we don't get too far behind. Make sure we're on the right track. So you are going to put in exactly the revenue that they show, but now instead of all of the cost of goods sold, we're only going to put in the variable amount. Okay, so I'm going to key in what I found in my spreadsheet here. And now our new subtotal is called manufacturing margin. Okay, so I got 326,800, 196,100, and 125,300. Now, I'm going to check my work because I want to make sure that I haven't missed anything. Okay, and if I've got to fix something, I'd rather fix it now while it's still pretty fresh in my mind what I'm doing. Okay, all right. So the next part is now we're going to put in the variable selling and admin. So just like we did for cost of goods sold, we have a certain amount here of total selling and admin. We're going to need to subtract this amount from that to get the line for the variable selling and admin. Okay, so I'm going to put that right here. I'm going to put selling and admin minus the fixed. Okay, minus the fixed selling and admin. Okay, so I'm going to put this in. I'm going to put 210,800 and I'm going to subtract 61,300 from it. Be sure you're looking at the second line here. Okay, so you don't. All right, so I got 149,500. I'm going to do that for golf. Okay, so if this is selling and admin for golf, then I've got 112,500 subtracting the selling and admin expenses, 36,800. Okay, and I'm going to do that for running now. So running is 147,000 minus 37,300. Okay, I got 109,700. All right, and then I need to do another subtotal contribution margin. Okay, so however much you found for your variable selling and admin, you're going to subtract that from the manufacturing margin, and you're finally down to your contribution margin. Okay, you have subtracted all the variable costs. Okay, and now you're ready for fixed. Okay, but before we do, let's go put those two more lines in. So now we've put in the variable selling and admin that then results in a subtotal of contribution margin. And I'm going to fill in my numbers. Okay, that goes with each of those three lines of shoes. $700, and now I have a contribution margin. Look, each kind of shoe is definitely got a different value that it is contributing to the margin. Are you seeing this? I don't know about you, but my running shoes are not helping much. You see this? Is your running shoes your lowest contribution margin? I hope so. Okay. Which one is the largest? Well, it looks like it's cross trainers for me. Okay. So now you're going to simply put in the fixed costs. Okay. Fixed overhead. All right. So we have those amounts. Let's put the labels in. We want fixed manufacturing overhead costs and fixed selling. Okay. And all we really need to do is look at what they're telling us those amounts were, right? They're all right there. So I'm just going to key these in for each line of shoes. Okay. Okay, those are all my fixed cost of goods manufactured. Okay, and then selling the fixed part, 61,300, 36,800, and 37,300. Okay, so you just put in whatever these are, and then you add your two fixed amounts together. You add them together. Okay, so this is a new subtotal here of just the fixed amounts. And I'm going to go ahead and key these in. Okay, I'm going to key in what I have in my spreadsheet here for my fixed manufacturing costs. Okay, and now I want to total both of these to our total fixed. Okay, so that's just a matter of totaling both of those amounts together. Okay. And now we're going to take the total fixed from the contribution margin. Okay. We're going to subtract the total fixed from the contribution margin, and my cross trainers have an operating income of 34,300. My golf shoes have 43,800, but those old running shoes, it's hurting. Okay, so you have a loss from the running shoes. Okay, so that should be what you should get, some kind of a loss right here, because the running shoes aren't contributing as much as we would like them to. Okay, so if you had to pick a line to eliminate, you might think about this one, right? Because once we get all this figured out, if running shoes are eliminated, okay? So here's the thing though, just because this says operating loss, we need to look up here first. They are actually contributing to the margin, right? So if we get rid of this, that margin goes away. Okay, that margin goes away if we get rid of this line. Okay, so if running shoes are eliminated, then $15,600 of the contribution margin is eliminated too. Okay, you can't just pull the plug on a product that's resulting in a loss, because there may be more to it than that. Okay, but it's a good place to start thinking about things. All right, so my contribution margin from my running shoes is 15,600. Okay, so if the running shoes were eliminated, then the contribution margin of the product line would be eliminated too. And the fixed costs, so they said up here, let me finish reading this. Here's what it says. Man, these fixed costs are used to support all three product lines and will not change with the elimination of any one product. Okay, so if you think about eliminating a product, it's not going to save you any fixed costs. In addition, you have determined that the effects of inventory can be ignored. Okay, the management of the company has deemed the profit performance of the running shoe line as unacceptable. Yeah, I can see why they think so, but as a result, it has decided to eliminate the running shoe. Management does not expect to be able to increase sales in the other two lines. However, as a result of eliminating the running shoe line, management expects the profits of the company to increase by 59,000. You would think that would happen. Okay, but here's why. Okay, so once again, this is looking at this. If we get rid of this, yes, it may seem like we're getting rid of a loss, but we're also going to be getting rid of 15,600 that's helping cover all of these fixed costs. Remember, if this goes away, these don't, right? So if this is zero, then look how much of a loss we're going to have, right? Because none of those fixed costs go away, right? Woo. So we probably ought to not eliminate this one, okay? And see if we can't work on making the running shoe more profitable, sell more of them, okay? Those kinds of things. So management decision and conclusion are incorrect. The profit will not be improved because the fixed costs in manufacturing and selling running shoes will not be avoided if the line is eliminated, right? So if we think this is bad, eliminating that line is hurting us even more. Okay, so one more time, if the running shoe were eliminated, then the contribution margin of the product line would be eliminated and the fixed costs will not be eliminated. Thus, the profit of the company would actually decline by, okay, the amount of 15,600, I believe, the amount of your contribution margin. Okay, let's see if that's right. Yep. Management should keep the line, attempt to improve the profitability of the product by maybe trying to increase the price, making the shoes more popular. So let's try to increase that volume. What else? What should we be doing to costs? We should be trying to decrease costs of that running shoe to see if we can make it more profitable, right? So those are the three things you could try to do to a line that looks like it's really hurting. Okay, you just can't make real quick assumptions like that because of what we're just looking at. Okay, where are we? Want to take a break? Need a little break? Okay, we're going to take a 5-minute break. Let's see if I can get some water. Try to get my throat to work better. Okay, we're going to keep going. All right, so, and I've got this on record, so I'm going to pause it. Those of you on Zoom, I'm pausing the recording a minute. Zoom recording. Okay. Now that we're working on quite a bit of this contribution margin business and trying to segregate all the variable costs and put those in the product costs and bring the fixed out, let's also think about if we have product lines or territories, right? And the profitability of those. All right, so here is kind of an interesting way of doing things. So this company is a Pipeline Surfboards Inc. manufactures and sells two types of surfboards. One's called Atlantic Wave and the other's called Pacific Pounder. These surfboards are sold in two regions, an East Coast and a West Coast. Here are the two surfboards information for both, okay? So I went ahead and put this together in a little table. Whatever this says is what and I've got to change it because I can see this is a different problem than what I've had before, which is fine. Because I want you guys to see that I'm just putting in whatever it's showing here. Okay, so we've got two surfboards. My Atlantic Wave is at 450. Pacific Pounder is 350. The variable cost of goods sold per unit is 167 and 161, which leaves us with a manufacturing margin of 283 and 189. Like I said, I'm just recreating what this is doing here. Then our variable selling per unit is 193, okay, and 98. All right, so it looks like we've got contribution margins per unit of the Atlantic Wave of $90 and 91. Now, does that surprise you? Look what's happening. We're selling this one for $100 more, but we're only hanging on to $90 of it when we subtract all these. We're selling this one for $350 and hanging on to even more than this one's hanging on to contribute to the rest of our expenses. So having said that, let's go ahead and show an analysis for the East Coast and the West Coast. Okay, so here's what you'll want. You want to go ahead and just put this in. We've got sales. Go ahead, let's put sales in at the top. Then our variable cost of goods sold. Then we get our manufacturing margin, which is our subtotal. Then we're going to subtract our variable selling. And then we're going to get to that contribution margin. Okay. Sometimes putting in these labels helps. All right. So here's where we're getting our sales numbers from. Okay. This is the sales price. Okay. So for the East Coast, all right, my sales are East Coast. My East Coast only sells the Atlantic Wave. They don't sell any Pacific Pounder. So I'm going to put 2960 here. And that 2960 is going to be times 450. Okay, so however much yours is. So my East Coast sales is just one of these products at a certain price, but they sell a lot of them. Okay. All right. Now let's do the revenue for or sales for your West Coast. And if you want to head out, that's fine. Or if you need to. Okay. Now let's do the sales for the West Coast. Now we do, and West Coast has equal amounts of both of these items, right? So we're going to have to calculate two sales amounts and add them together. So the Atlantic Wave is at a price of 450. We take that times 1,660 plus 350 times 1,160. And when we add them together, the West Coast is doing this much in revenue. Okay. So I've got to put this in. Okay. So it looks to me like both regions are doing pretty close to each other, right? Yeah. Now we've got to get those variable cost of goods sold. So based on what we're selling up here, we've got to come up with the variable costs, right? So the variable cost of goods sold for the Atlantic Wave is 167, and the variable cost of goods sold for the Pacific Pounder is 161. Well, the East Coast doesn't sell any Pacific Pounders, so their cost of goods sold is the 2,960 units. Oh, guess what I forgot to do? I forgot to put in my new numbers for the West Coast. My fault. Just a second. I just now seen this. So my numbers for the West Coast, luckily, they're still the same number for each, which is good. And then this is gonna show that the number that we're selling times its sales price plus the number that we're selling times the sales price. We're gonna need to do that now for the variable cost of goods sold. So we're gonna take all of this Atlantic Wave times the variable cost of goods sold, which is 167. And I put this in as a negative because we're gonna subtract that from the sales to get our manufacturing margin. Then I gotta add two amounts for the West Coast variable cost of goods sold. So the variable cost of goods sold for the Atlantic Wave is this number, or this cost times the number we're selling. And this cost times the number we're selling. So the cost of the surfboards for the manufacturing of it isn't that different, right? It's not that different. Okay, so I'm going to key these in. I'm going to see what happens if we key in negative. I just want to see if they accept it or they don't. I'd like it if they would. I would like it if they would. Let's see if they allow this. Nope. Okay, I've got to change my sales because I hadn't changed my numbers. So let me try this again. Okay, so, and it's okay to put the negatives in there, that's good. So now we want to see what our manufacturing margin calculates to. So I got 837, 680. Okay, and I've got 698, 560. Now we're ready for variable selling. Okay, variable selling, and this is where things are going to change. Because look at how much more the variable selling is for this particular surfboard, right, as this one. So this is almost twice as much as that. And I think you're going to see quite a difference. So because the East Coast sells only Atlantic Wave, the variable selling and admin is going to be the 2,960 units that they sell times $193 each, right? And when we subtract that, we get a contribution margin. And then the other one is some from both, right? So then we have to do the variable expense. So we want 193 times 1,480 plus 198 times 1,480. So for whatever reason, this line of surfboard doesn't cost near as much in variable selling, okay? And because of that, look what happened to the contribution margin for the West Coast, right? It's because they sell some of the ones that don't cost as much with the selling. So let's put these numbers in. I got 571,280. Okay, and I got 430,680. Now you've got to put your contribution margin down. I got 266,400 and 267,880. So you would have thought that because, excuse me, you would have thought because they do half of these that doesn't cost as much, it would be quite a difference. But so now what we need to do is come up with the contribution margin. Okay, the contribution margin ratio. If you see the word contribution margin, that means dollars. Okay, but if you see the word ratio, then this is a percentage. So how we find this is we take that contribution margin and we divide by the sales of that region. Okay, so what this is saying is that the East Coast is hanging on to 20% of their sales dollars to put toward paying off paying for other expenses, right? And the West Coast is doing a little better. Why? Because it looks like they're doing a combination of these. What if they just focused on the Pacific Pounders? You could put this in here and make this work, right? And see what would happen just for fun. But let's go ahead and put these numbers in before I start into the fun there. Let's put 20%, and they want 2 decimal places. So be sure to put those in or it won't work. Let's see if I've got my numbers put in here right. Okay. So it looks like it. And so now let's answer the questions. What advice would you give? The total contribution margin is slightly lower for the West Coast or East Coast, right? The total contribution margin is slightly lower for the East Coast, right? East is a little smaller than West, while the contribution margin ratio is slightly higher for the West Coast. Okay, hopefully you found that. And we see that right here. Okay. This is because East Coast sells only Atlantic Wave, which have a higher or actually a lower contribution margin per unit. So their contribution margin per unit is only 90, right? In attempting to improve the company's profitability, it is likely that changing the mix of products to the 2 territories will have much effect. In addition, the variable selling expenses per unit, right? That was the biggest difference, was the variable selling expense per unit for the maybe too high. All right. So for the Atlantic Wave is pretty high. That's a lot higher than that one. We need to find out why. Hold on. In attempting to improve company's profitability, it is unlikely that changing the mix of products to the 2 territories will have much effect. Okay, well, we're going to see about that. Okay, so there are your answers, right? So here's what I'm going to do just for fun. I'm going to take the same amount that the East Coast sells in just this wave, just this surfboard, and put them all here. See what happens. Okay. So if the West Coast decided to sell exactly the same amount of surfboards and take out the amount, look at the difference. Whoa, that's pretty good difference in the contribution margin percentage. Do you agree?
How did you get the percentages again?
Okay, percentages are found by taking your contribution margin ratio, a contribution margin in dollars, and divided by your sales. Okay,
Oh, okay.
this
Okay.
divided by your sales. So let me put this back. Okay, let me put it back.
And then times 100. Okay.
Yeah. So here's how much they had. So they're doing an equal amount of one product and another. On the West Coast, they're doing completely one product. So you could kind of mix up. So what if you did exactly half of that by mixing it up? Once you have this analysis figured out, you can mix it up. Okay, so yeah, it's 1480. So if we mixed it up, then what would happen? Okay. Okay, so all right, we'll just stay with what they had. So back up here, 2960. Okay, and I'm going to take these out. So the nice thing about this kind of an analysis is you can put in different scenarios and have some idea of what might be happening, okay? If we did this, what would happen? Right? So product mix can sometimes definitely make a difference. But it doesn't seem like it makes that much difference. What if they just dropped, okay, what if they just dropped this Atlantic wave altogether? What if they both just concentrated on the Atlantic wave? And that's what they did. And I'm gonna take these out just for fun. Well, the East Coast isn't gonna do anything. It'll be the same. It'll be the same because they're gonna be selling the same thing. But we also have to remember that we don't know all the factors about what goes on the East Coast versus what goes on the West Coast. I don't know anything about surfboards. I don't know how you decide what surfboard to buy or any of that stuff. So I'm just trying to say there might be other factors that come into play, but you can start analyzing profitability by territory and product by setting up something like this, okay? All right, let's keep going. Okay, now we're going to start evaluating sales territory and sales person profitability, okay? So we can work on this. All right, so I'm gonna put this in. We've got 4 people. These 4 people represent different parts, different territories, different sales territories. Okay, so, no, I'm sorry. We have 2 territories, a northeast, and a southwest, and a southwest. But we have different salespeople under each of these territories. So we're just gonna keep it with the 4 salespeople here. All right. Now what we need to do is to come up with the contribution margin by salesperson report. Okay. So I went ahead and put this in. All I did was, and let me see if it's still the same. So the average sales price, oh, we're selling commercial vehicles. Okay. The average sales price for this salesperson, for their commercial vehicles, $15,500. $16,000 for Steve, $13,000 for Colleen, and $19,000 for Paul. Now we're going to put in their variable cost of goods sold. Okay, so I've got 93,000, 8,000, 7,800, and 9,500, and I put those in negative numbers. Okay, because I'm going to be solving for the contribution margin. Okay. Here's the commission rate. Here's the number of units that they sell. And here's the manufacturing margin ratio. Okay. So let's get started. The first thing we're going to put in is what is the volume of sales that we're getting from each salesperson. So you take the sales price, right, times the number of units that they're selling. That's how you're getting the sales. So for my Renee, since she's selling, the average sales price is 15,500 times 38. And I get 589,000 for her sales. Okay, so we want to go across here and put in how much each of the sales volume is for each of these salespeople. Okay. Okay, so if all you were looking at was sales volume, who's in the lead? Now, I don't know what yours is saying, but the person that's in the lead for me, oh, okay, let me see what I did here. Okay, maybe I missed it. But it did change. You dog. Okay, so there's only 34. Look, hold on. There was only 34 they sold here. So that's why my total sales is off, so I gotta go back and put 527. That's okay. It made me realize that I'm not paying as good of attention. Okay, so now we want the variable cost of goods sold, variable cost of goods sold. Now remember, this is per unit sold, all right? So I'm going to take 34 units times the variable cost of goods sold and put that amount in. Okay, and we're going to do this for each one. Take the number they're selling times their variable cost of goods sold. Okay. So the variable cost of goods sold for each one of these, and then we're going to get a contribution margin. Okay, so okay, and now we want contribution. No, now we want manufacturing margin. Okay, manufacturing margin. So this is, remember, this is a variable costing report. So we want to subtract the variable cost of goods sold from the sales. Okay, and that's getting us this second subtotal, the manufacturing margin. Okay, so I'm going to put these numbers in now. Okay, so you may need to take a little time to do this. Okay, so okay, whoops. So now we want to put in here the variable commission expense. Okay, so let me make sure I'm reading this right. Okay, so let me go back over here. So yes, the variable. So how do we get the commission, the variable commission? So we take 7%, the commission rate, 7% of, okay, so let me see here. 7% times the total sales. That's how you're getting your variable commission expense. Okay, so you take whatever your commission rate is times the sales volume of that salesperson. Okay, and you're going to put this in. Okay, so I got 36,890. Okay, and then Steve gets a commission of 13% times the total sales. So we're looking at $54,080. Okay, and then Colleen is 10% times the total sales. Okay, is 52,000. Okay, and then the commission for Paul is 91,200 because he has commission of 8%. 8% of his, he's the largest salesperson volume. Okay, so we're going to put that number in. So 91,200. Let's see if we're right. Okay, they don't make you put in the negatives, but if you wanted to put in the negatives, you could. Let me see what has changed here. Something has changed on my commission. So yes, my commission for Steve is 11%. So I miscalculated that. Okay, so it's 45,760. And then we want our contribution margin. Okay, contribution margin is the variable commission expense subtracted from the manufacturing margin. Okay, manufacturing margin. And they even give you the manufacturing margin ratio here. Okay. All right, so let me put this in. Okay, so I've got 173,910 for Renee. When I subtract the variable commission expense for Steve, I get 162,240. And 156,000 for Colleen as her contribution margin, and Paul should have a pretty good contribution margin. He had the most sales, right? Yeah. So 478,800. Now you need to find your contribution margin ratio. So how do you do that? You take your contribution margin divided by your sales, okay? Divided by your sales. It says compute the contribution margin for each salesperson. So what this is saying is for every dollar that Renee sells, she's hanging on to 33% of every dollar to contribute, right? Steve is hanging on to 39%. Colleen is only hanging on to 30%. And then Paul, who is the big salesperson, is hanging on to 42%. Okay, so let's check and see if the work is right or not. Okay, so it's just good to have it's good to have actually a spreadsheet, okay, a spreadsheet. And then we need to interpret some things about these salespeople, right? So let's start with Paul. He's the lead salesperson. He's doing the most in volume and of course in contribution margin. And he's hanging on to the biggest percentage of his sales dollars. Okay, so what's going on with these three? So Paul earns the highest contribution margin and therefore has the highest contribution margin ratio. Okay, that shouldn't be a surprise. This is because he sells the most number of units and has a lower commission rate, right? So his commission is 8%. That's almost as low as Renee, okay? So the lower your commission rate for expenses, the better. He sells a product mix with a higher manufacturing margin, right? So the manufacturing margin for Paul is 50, but so is Steve's. Okay, so let me make sure I've put these in, okay? 40, 50, 40, 50. Yes, they're giving these to us, okay? All right, so high manufacturing margin. Steve also sells products with a high average manufacturing margin, but at a lower commission rate. Colleen has, so if we go look at Colleen, she has the lowest contribution margin. They say poorest, I say lowest, but okay. Contribution margin among the four salespeople. Although Renee has high variable cost of goods sold and also sells products with a, okay, so we're looking at Renee here. Here's the cost of the variable cost of goods sold. So a higher variable cost of goods sold, but sells products with a sales price that's higher, should be higher per unit. And she has the second highest total contribution margin, okay? So she has the second highest. So here's your highest contribution margin. Okay, just a minute. I may have different answers here. This was based on what I did last night. Okay, so I think I've got some to fix here. So let me fix them. So Steve sells the products with the high average manufacturing margin, but at a high commission rate. Okay. So Colleen has the poorest contribution rate among the four salespeople, although Renee has a high variable cost of goods sold and also sells products with a low average sales price. She has the second highest total contribution margin. So if these are your contribution margins, Renee is the second in dollars, right? But not the second in the percentage. Here's the highest and here's the second here. So just because you have the second, just because your dollars fall in line, doesn't mean that your contribution margin is going to be exactly the same. Okay. Okay, so now we want to go to, the sales territory. By the northeast and the southwest, which I think I forgot to do. Yep. Okay, so let me see what I can do real quick. We're just about to finish up here. All right, so I'm going to give myself some more room to do a little analysis here. I must have skipped this, which is not surprising. Okay, so I'm going to give myself some room here and move this down. And I'm just going to put in northeast and southwest. Okay. So if I understand things right, these are Renee and Steve are the two northeast. Yep. All right. So I'm just going to put northeast down here and I'm going to repeat this. Okay. So what I'm going to do is bring this down here and put this in. Okay, so I just want these that I'm going to bring down. And this is going to be for the sales territory. And we only need two. Okay, we only need a northeast and a southwest. So I'm renaming these northeast. I think this is southwest. Okay, so I've got a little bit of work to do here. So don't freak out that I don't have all that in there. All right. Okay. So now we're going to prepare a contribution margin by territory. So we're still going to use sales. Okay. Then we're going to take out the variable cost of goods sold. We're going to get to a manufacturing margin. Okay. Manufacturing margin. Then we want that contribution margin. And then, no. Okay, I'm gonna go back here. Nope, we want variable commission, then we want contribution margin, and then we're ready. Okay, so we're gonna have to add some things together to get our numbers, right? So our sales are gonna be everything added together for these two columns. Okay, so I'm going to make a formula here that will put in both Renee and Steve's sales dollars. Okay, once I put this formula in, I should be able to drag this down, okay, and see what we get, at least for some of it. Okay, so let me see here what I've got. Sometimes it doesn't work exactly like this, but if we take the northeast, okay, so here is, whoops, hold on. All right, let me go back. Let me double check that this is adding up. This should be adding up. Actually, so I don't have this one right. This should add up E 125 and F 125. So you got to make sure that your formula is working. Okay, so sure enough, that's adding up both of those. Okay, now I should be able to come down here and just bring that formula down, and it's going to add up these two amounts. Okay, so you would add the two variable cost of goods sold, right? And then you're going to get a manufacturing margin. So I'm going to put the northeast amount in, 943,000. Okay, the variable cost of goods sold is 524,200. When you add up what's going on in these two columns, okay, now we want to put a manufacturing margin, right? Which you just do do the math there. Okay, you're gonna subtract it. Okay, so 418,800 is the manufacturing margin for the Northeast. Okay, now we've got to add the two variable commissions together. Okay, so we got to add those together. Okay, so it's 82,650. And then we're going to subtract that from the manufacturing margin to get our contribution margin. So I'm going to bring these over. I don't know why I made so much room for this. It's kind of crazy. So here are our variables beside this. We're just putting in these so I don't have to scroll over so far. So now I need a contribution margin. Okay, the contribution margin for Northeast is to take the manufacturing margin and subtract both of their variable commission expenses. Okay, so then we get a contribution margin of 336,150. Let's see if I'm on the right track. And then we're going to divide for the contribution margin ratio. We're going to take that contribution margin in dollars and divide by the sales. Okay, and I need to turn this into a percentage. Okay, so I'm picking a percentage and they want it rounded to 1 decimal place. Okay, so I've got 35.6. Let's see if I'm anywhere close. All right. Okay, now I need to do the other two salespeople. Okay, for the Southwest. So I'm going to take Colleen plus what we have for Paul. Okay, and wow, that's quite a bit in sales. Okay, so I've got 1,660,000 for both Colleen and Paul added together. Now I'm just going to bring my formula down. When you bring this formula down, if you've got things lined up okay, then it should add these two lines together right below. So we're looking at variable cost of goods sold of 882,000. Okay, if you keep going, this should go ahead and finish out down here. Okay, the only one you might not be able to do is come up with your contribution margin ratio. You should be able to come up with your contribution margin in dollars, but you might have to make sure the formula is working for the contribution margin ratio. So I like to put my equal signs in so I know where I'm putting in a subtotal. So let me put in my numbers now. Okay, so because Paul is the best salesperson and Colleen isn't too bad, even though Colleen has the lowest contribution margin ratio. Okay, so let's put this in. I got 778,000. I'm going to subtract their combined variable commission expense. And I got a contribution margin for the Southwest Territory of 634,800. Let's see if that's right. Okay, now we simply want to do a calculation, right? Let's just calculate the contribution margin in dollars by dividing it by the total sales. So I got 32 or 38.2 because they only want it to 1 decimal place. Okay, so I'm going to get rid of, so we're at 38.2. Okay, 38.2. Wow. So let's see what this says. Let's see if we can make sense of it. It's not quite that much different. I mean, it's quite a bit different in dollars, but the percentages aren't that far apart. So let's see if we can interpret this. The Southwest region has how much more in sales? Okay, how much more in sales and how much more in contribution margin? Okay, so we're gonna have to come up with the difference, okay? So if we want to know the difference, we can do a calculation here. So Southwest, and we're going to subtract Northeast, and Southwest sold 717,000 more in sales than the Northeast. That seems like a lot. Okay, now let's see how much difference is in the contribution margin. All right, so the contribution margin is Southwest minus Northeast to find the difference. So the difference in the contribution margin is 298,650. Okay. In the Southwest region, the salesperson with the highest unit volume has a blank contribution margin. So if you go look at Paul, his contribution margin is 42%, right? Yep. Has the highest contribution margin. The Southwest region has the lowest contribution margin, I think. Wait, hang on. One more time. In the Southwest region, the salesperson with the highest sales unit volume has the highest contribution margin. The Southwest region has the blank performance. Okay, so Southwest region has the highest performance, even though it also has the salesperson with the lowest contribution margin. So that lower contribution margin from Colleen of 30% is dragging down the one for Paul. Yep, a little bit. All right, let's look at the Northeast now. So in the Northeast region, contribution margin is lower than the Southwest, is less than, so one more time, the Northeast region, the dollar value is lower in the contribution margin than the Southwest region because of the outstanding performance of, I would say, okay, so I would say it's Paul, right? The Northeast region contribution margin, Northeast contribution margin is more than the Southwest region because of the outstanding performance of Paul. We know Paul is doing the best. Okay, so I thought I picked that right. The Northeast region contribution margin, Northeast contribution margin is up here, is less than, okay, all right, I'm going with it. The Northeast region's contribution margin, that's this. Contribution margin is right here, 336,150. Then the Southeast, because the outstanding performance of Paul, okay? So Paul really helped bring Southwest up to better performance, okay? So sorry, I have forgotten to do that part of this problem. Okay, Daniel, do you need to go? Okay, I'm gonna finish her out, okay?
Yes,
Okay,
I'm gonna finish up and then I'll
okay.
head out.
So believe it or not, I think you're gonna find these others not too bad. Okay, so we're gonna do something similar to this with another set of salespeople, okay? So what we're gonna do here is we've got salespeople, we've got 7 salespeople that sell and distribute product throughout the state. Here is sales data for the year for each of the sales people. Now I went ahead and put these in just a little table here, and I'm gonna put this over here. Now I'm gonna go back through because I've got to put new numbers in because I've got a new problem, right? So I've got to put these in too. So you could just put 1 through 7 is your salespeople. Whatever you want to put their name, that's fine. But I've got to put new numbers. And I've got to be careful when I put these in, just like you do. Okay, so we have total sales, variable cost of goods sold, and variable selling expenses. And we have a different amount for each salesperson. Okay, so let's carefully put these in. If you have time, if not, the video will be out here for you. Okay, so thank goodness. All right, so I've got my first 2 salespeople in. I hear the Zoomers taking off, and that's okay. All right. So we're gonna put the data in a table. This is good practice if you need a little practice in Excel. Okay. There's nothing like learning how to key stuff in by doing it. And I've had quite a bit of practice keying stuff in, and I still mess up sometimes. So it's really hard to pay attention when you're talking. Okay. And then I'm going to go back through here and make sure that I've got the right numbers in, because everything I'm doing in this problem counts on me putting in the right numbers. So I'm just going to audit my numbers real quick. I'm going to go vertically now, see if it looks like I've got things right. So far, so good. Okay. So now, make you another table with 7 people. Okay. So just like this one, you can copy and paste it down here. But now we're going to calculate the contribution margin for each of the salespeople. So what is that? The contribution margin, when you're looking at variable costs of goods sold, right, is the variable costs and the variable selling expense. So it's going to be this total sales minus. That will get you your contribution margin in dollars, okay? And I like to put that that's going to be in dollars. So here's the calculation. You start with the total sales. You subtract variable cost of goods sold and subtract variable selling expense. And you get a total of contribution margin dollars for that salesperson. And you're going to want to put that amount here as the contribution margin. Okay, so I'm going to put this in. Okay, now I'm going to go through here and make sure that all of these are calculating correctly. Okay. Okay, so this one looks like it is. We'll see. No, I don't want to replace it. Okay. So let's keep putting in numbers. Okay. Okay, so I'm going to make sure. And then okay. So now you're gonna do some percentages, okay? We're gonna come up with the percentage of the variable costs, right? So you have this variable cost up here. So how did I get 48% here? I took the variable cost of goods sold and I divided it by the sales. Okay? And I did that for every employee, right? Every employee. So this should be the percentages for each of these. And once again, you take the variable cost of goods sold divided by the sales, okay? And then you put in your percentages because they only want it to the nearest whole number, okay? So don't put any decimals to these. We'll see if we are correct. Okay, so okay, now we're going to do the same thing, but for the variable sales expense, right? So variable sales expense percentage is the dollars of variable sales expense per employee divided by the sales. Okay, divided by the sales. So then you can just drag this down and it will follow that same formula, okay? And you can put in these amounts into your table on Cengage, okay? So let's put these amounts in. And then the last one is the contribution margin. So once you know what your contribution margin is, you can divide it by sales and you get percentages of each of those. Okay, so let's see if my calculations are correct. I think this is the most Excel that I've had to use in managerial accounting, but I'm not surprised at all. Not surprised at all. So then I have that contribution margin added on to this one. And once again, to get the contribution margin ratio, you take the contribution margin in dollars and divide by each salesperson's total sales. Okay, and that's going to give you a percent. Okay, so for every dollar of salesperson case, they're hanging on to 30%, 30 cents of every dollar. Dick's is hanging on to 27%. Johnson is hanging on to 49%, 43%. Orcus is hanging on to 49%. Sussman is the lowest contribution margin ratio of 24%. Wilbon is 40%. Okay, so once you put that information in, okay, we should be able to come up with a few things about these salespeople. So which salesperson generated the highest contribution margin ratio for the year? Okay, for the year. Well, I have, what are our choices here? Which salesperson, okay, and I got all these right. Okay, so the highest number that I see, contribution margin ratio, is 49%. And that is Orcus and Johnson. So how can you have just one? Let's look. Well, let's see if it accepts it. Okay, what if you picked Orca? Is that right too? No. Okay, what happened? Okay, why is my Orca? Okay, so I got Johnson, okay. There must be something different for mine. So I need to go look. All right, so up here, well, this is answering right. Okay, so For me, Johnson has the first highest contribution margin ratio. But I'm showing Orca is the same number, but maybe if you take off the percentages, let me take these out to a little further here. Nope, they're all even. So I think this one, and maybe I'm misreading this. So if you're reading this different than me, let me know which salesperson generated the highest contribution margin ratio. We're talking the ratio, which is a percentage. The first one that I got was Johnson, and they liked that. But Orca's is also listed as 49%. So I'm not sure what's going on. So let me just double check. 49%, there's my contribution margin divided by the sales. Okay, and they say that Johnson should be the one. So this one isn't working right, if I'm understanding things correctly, because there really are two salespeople with the same contribution margin ratio. Okay, identify the factors other than contribution margin that should be considered in evaluating the performance of the salespeople. Well, all of these things matter. Okay, all of these things matter when you're looking at evaluating the performance. There's one other thing I want to look at. So when they're talking about the contribution margin, Orca actually has a higher dollar value than Johnson does. Does everybody see that? But they wanted the highest contribution margin. So what I'm going to do for this, since this didn't answer correctly, you can make it answer correctly. I think you guys all have Johnson as your highest. If not, let me know. Otherwise, I'm just going to disallow this question. Okay, I'm just going to. What does yours say, Daniel?
Mine was,
Another person?
yeah.
Okay, so
Is there two then?
was there two for you?
So mine's saying Johnson's wrong,
Okay,
but I guess, well, we don't have the same questions.
right. So when you figure your contribution margin, when you take the dollar value of each of these seven
Mhm.
and divide by the sales, do you have just one percentage that's the highest? I have two.
That is no, I only have one.
Okay, so I have two. See what I mean? So I
Yeah.
have 49% for Johnson. So and I have 49% for Orcas. Okay, for whatever reason, and they said that both of these amounts up here are correct. See that? There's the 49 and there's the 49. So this question, I'm going to disallow. So I'm going to add back the score for these problems because this one's not working right. It should work right for each version, right? You have a different version than I do. And yours is working because you only have one contribution margin ratio that's the highest, and that is the one that it answers correctly. Am I right? Okay, so you'll need to check your work. Anyway, I'm not going to worry about this one. If you miss it or didn't get it, I'm just gonna add back the amount that takes off if I get it wrong. So I'm gonna pick the wrong one. Okay, I'm picking the wrong one right now and checking it. Think, maybe. Well, come on and check my work now. Then you have to refresh. See how it's showing that my problem has something incorrect on it? And what's incorrect is the person that has the highest contribution margin ratio. Okay, so I want to see what that score is because I'm going to add that back to everybody's problem. Okay, so we've got I'm just gonna add back, so we've got 30 points here for all of these. And I'm going to just take out the amount of number 6 because I don't want anybody penalized because the problem isn't operating correctly, and I need to tell them that it's not. So if I take 30 points divided by 7, there's 4.29. So I'm gonna add back, I'll add 4.3 to everybody's score, okay? So just don't worry too much about this one. You might make it correct, because you can go down through here and make it correct if you want to, but it shouldn't be answering this way. I shouldn't have 2 to choose from and then not have the choice of 2, right? If this said Johnson and Orcas as a selection, then I could understand it, but it doesn't. So this one's not working right, and Cengage needs to know. Okay, this last one is putting together an absorption and a variable costing income statement with a set of numbers. So let's see if we can do this. Okay. So what I'm going to do is open up all of the windows here. Okay. Let's put down some information we need to know in order to start doing this. Okay. Because we all have different versions. This is the first month of operations. Okay. So just in case we need to know, this is first month of operations. And it is for the month of March. We just finished our month of March yesterday. I want you to put down, my problem is showing that I'm manufacturing 165 mini refrigerators, but I'm selling 150, okay? So I would recommend that you put this down, how many you're producing versus how many you're selling. And then I would come up with what the difference is in that number. So because you're going to have a different income on the absorption costing income statement than your contribution costing income statement, okay? Because you're producing more than you're selling. And the difference for me is 15,000 mini refrigerators, okay? So you need to figure that. So start off with that information here on a piece of paper or on a spreadsheet, okay? Everybody got that? I think we all have the fact that we are producing more than we're selling, okay? I believe so. And I've got to watch real close because they may change numbers on me and I don't know it. Here's what I would do next. I would take all of this that you see and I would put it in a spreadsheet, okay? So we've got sales and I've got 11,250,000. Yes, that is the right number for my version. Then I've got direct materials, okay? Direct materials is 1,980,000. I've got direct labor of 4,290,000. I've got variable manufacturing overhead cost of 412,500, and then fixed manufacturing overhead of 2,475,000. So that all 4 of these add up to just exactly what this says. Okay. All right. Don't worry, we're going to get the per unit value here in just a minute. And we're going to get that here in just a minute. So I need to make sure that my formula here doesn't go astray. Yes. Okay, I've got to fix this. Okay, I've got to fix this. So what this should be is the total of all 4 of these manufacturing costs, so I've got to put some. And I'm gonna add these up. And when I add them together, it should be what you see in your problem, okay? Now I'm ready to put in my variable and my fixed for selling and admin. Okay, I have a variable amount of 450,000 and a fixed amount of selling admin for 1,125,000. So I got lucky that I got the same problem. What I don't like about this problem, look, they stuck on cents on the end of these numbers, and that doesn't help. Okay, we don't need the cents, so you don't really need those in there, okay? But this is all matching up now. Here's what I want you to do next. Okay, here's what I want you to do next. We've got to come up with a direct materials unit cost, okay? Remember, we're producing in this area, right? We're producing. So to come up with the direct materials costs, we've got to take the total direct materials and divide by the number that we produced, right? Okay, so how I got this $12 is I took my total direct materials cost, okay? So right beside it, I'm gonna put how I got this number, okay? How I got this number here, number 12. Actually, let me make this wider. I'm gonna put here how I'm getting this number. This number 12 is calculated by taking my total direct materials costs of 1,000 or 1,980,000, and I'm going to divide by the number produced, right? So my number produced is 165,000 units. That's how I'm getting the number 12. Okay, you're going to need to solve for that in order to go any further with the problem. Okay, let's do the same thing for direct labor. Let's take the amount of direct labor in total divided by the number of units produced, okay? And when we do the math, we get a certain amount per unit of direct labor. And mine is $26. So these are all dollars, by the way. Okay, so I want to make sure everybody knows these are all dollars. And I'm going to go ahead and leave them, because one of mine is $2.50. Maybe that's what part of the issue is, okay? So the next one then takes my 412,500 divided by 165,000. Okay. Let me see here. Why is it doing that? Okay, let me see what I've got. Okay, no, it shouldn't do that. Okay, so I'm taking out the cents. Okay, so here is, and I need to take the cents out of this one because it's okay, it comes up to an even number. Okay, we just needed the cents for the variable manufacturing overhead cost per unit. So if you take 412,500 and divide by the number produced, which is the 165,000, we should get $2.50. Let's make sure. 412,500 divided by 165,000 gives me $2.50. Okay, now we're going to do the fixed manufacturing overhead. So I got 2,475,000. I'm going to divide it by the number produced to get $15 per unit of fixed costs, okay? So here are my costs per produced unit, okay? And it's all based on the extra that we're selling, okay? Now go down here to variable, do the same thing, okay? Because we're gonna need to break that up. So how much is the variable cost per unit for selling and admin? So I have $450,000. I'm gonna divide that by 165,000. Okay, let's make sure that I've got that in here, okay? All right, it looks right. Okay, and then the fixed get divided out by all the numbers produced. So all of these manufacturing costs are by that, okay? So we're dividing this, so I'm gonna see if this holds. I'm gonna see if this holds, so let me see. So the first one we're gonna do is the absorption costing income statement, which, by the way, is for the period of, for the month of March 31st, okay? So let's go ahead and put both of these labels in for both of these income statements, okay? So I've got them both open. So we have the same label there, and you can check your work, make sure you got the same label, right? One just says absorption costing income statement, and the other one says variable costing income statement, okay? So let's start off with the absorption. So that's going to be sales, okay? Sales is at the top. Okay, and they already told me it's 11,250,000, and that is going to be the same. Here is the income statement for absorption. Here is the income statement for variable cost. Okay, so let's go ahead and put in both of those amounts. So we'll kind of do these income statements together. All right, so put in however much your problem says is your sales. Okay, for both, because that starts off the same. Okay, now we have a label. Okay, the label is going to be for absorption. It should be, okay, so I need a label here. Okay, I didn't go that far. So we're going to put in our cost of goods sold. Okay, so this is going to be cost of goods sold. Okay, cost of goods sold should be a label. So go up here in the label area and pick cost of goods sold. Okay, now the other one is going to be the variable cost of goods sold. So go pick the other label for the other one. Let's feed in our labels first, so we can try to keep track of what we're doing. Okay, so now we're going to get the cost of goods manufactured. Okay, cost of goods manufactured, and then we're going to get an ending inventory because, all right, so cost of goods sold. Let me see if I can make sure. Cost of goods sold is up here. So the amount that we were given in the problem is going to go in here. Okay, so there's a label. So the amount description is the cost of goods manufactured. Okay, so let's go look at an amount description. It's the cost of goods manufactured. So I need to change that to that. So let me fix it here. This should be the cost of goods manufactured. Cost of goods manufactured. Okay. So that's adding up all four of those amounts that's up here. I'm gonna make sure I'm right. Okay, so this is all of them. So that's how much should be in the cost of goods manufactured right here. Okay. So let me put that in. I'm putting the amount and I'm gonna go get the label. So I got 9,157,500. And that should be cost of goods manufactured. Let's see, the amount description. Cost of goods manufactured. There it is. So let's put that label in. Okay, and then we're gonna go get the inventory on the last day. Okay, inventory on the last day. So it should say inventory March 31st. There it is. Okay, let's bring that in. Okay, and this is easy. When it comes to absorption, we're not separating out any fixed costs. So we just put 0 there, I believe. Now, why did I put something else? That's very interesting. Okay. Let me see if I'm right. I may need to go back. Okay, so I do need to change this. Okay, so it is not 0. Okay, so we were kind of going by what we were doing before. But underneath here is going to be total cost of goods sold. So let's go get total cost of goods sold. Okay, because we have to add, because we are producing more than we're selling. Okay, we're producing more than we're selling. So we need to come up with an inventory amount. Okay, so the inventory amount, I've got to figure out how much each of these items that's in cost of goods manufactured, right? So I'm going to take cost of goods manufactured, the whole amount, and I'm going to divide by the number that we produced. Okay, so all of my units that I produced add up to 555.50 each. So let me see if I add all these up here. Yep. If you add up all of these, it adds up to $550 each. Okay, there is 15,000 still in inventory. So the number that goes here that needs to be subtracted from that cost of goods manufactured is the number of units in inventory. We've got 15,000 units that need a value right here. And that value is going to be 15,000 units. $15,000 at a cost of $55.50 each is the number that you put in for inventory. Okay, so whatever your difference is, hopefully you know the difference in the amount of units that you're producing versus the amount you're selling. So you're going to have some left over in inventory, and that amount needs to be subtracted. All right, so the amount will be, for me, is 832,500. I want to subtract that. Okay, I'm going to put that in as a negative. Okay, I want to subtract that from the cost of goods manufactured. Okay, cost of goods manufactured. So I'm putting 832,000. I don't think it's going to let me put it in as a negative. Sorry. So I got to put it in as a positive, but I got to remember to subtract it. Okay, I've got to remember to subtract it to get my total cost of goods sold, because I got to take some out of the manufacturing cost because we are coming up with the total sold. and it's less than the total manufactured. So I got 8,325,000 as my total cost of goods sold. Okay, after the cost of goods sold, we want our gross profit. Okay, gross profit. This is absorption. So this is the old way of doing it. So all we need is the gross profit. So this is a new subtotal. My gross profit is, when I subtract the cost of goods sold, I have a gross profit of 2,925,000. Okay? Gross profit. Then we're going to subtract the selling and admin expenses. My selling and admin expenses add up to a total together. We're going to put them all together. So both of these add up to 1,575,000. So I'm going to put selling and admin expenses right here. And I'm going to subtract that total to get my operating income. Okay, operating income. So let's just do the math. So we are going to have different operating incomes on these income statements. Okay, so I got 1,350,000 for my operating income on my absorption. So my absorption is going to be, should be higher in income than my variable costing. Okay, so if we go back up here and look again, I am producing more refrigerators than I'm selling. Remember, one more time, when you produce more than you sell, what happens to the income? Okay, and I'm going to put that right here beside it so that we can remember that and test it out, right? So when we produce more than we sell, then our variable income will be lower. Variable income will be lower than our absorption. We're going to see if that holds true. Okay, absorption income. Okay, and this is just following the rule that we talked about in the beginning. Okay, now let's put together this other income statement. And so we're going to expect our operating income to be different. Okay, we're going to expect it to be different. So you might double check that you put everything in correctly for your absorption income statement. Good, so here comes the,
Can you keep it? Sorry,
No.
just 2 seconds.
no, there's a lot of work here. A lot of work.
Thank you.
You bet. Okay, so now we're going to divide it up into variable. Okay. Whew. All right, so here's what we have. We have the same.
Okay, I'm good. Thank you.
Good. Okay, so we start off with the same sales, so that doesn't change. We have a label of the variable cost of goods sold. So we're going to do the variable cost of goods manufactured. Okay, variable cost of goods manufactured. So let's go find that label. Variable cost of, where am I at? Yes, variable cost of goods manufactured should be, yes, it's right here. Variable cost of goods manufactured. Okay, we're going to put the labels in first. Okay, so I'm going to walk you through these labels. We're going to put the variable cost of goods manufactured, and then we're going to put the variable cost of the inventory. Okay, the inventory. Okay, variable cost of goods manufactured. And we got to calculate that because we have to put an amount in. So hang on to that. So now we're going to go get the inventory on March 31st. So we're going to use that same label here. Okay, so let's see should be the same label, inventory, March 31st. Let's put that in. All right, and then we're gonna get our total variable cost of goods sold. So there should be one that says total variable cost of goods sold. And it goes in as that label, okay? When we subtract the cost of goods sold, our new subtotal is that manufacturing margin, okay? Manufacturing margin. Let's put that in. This takes a lot of patience. Okay, manufacturing margin. Okay. All right, and then we're gonna go get the variable selling and admin. Right, so let's go find the variable selling and admin expense label. So we know which one we're gonna be working on. Variable selling and admin expense label. It goes in after the manufacturing margin. Okay. Then we have our second subtotal. Our second subtotal is contribution margin. Okay, contribution margin. Let's go see if we can find contribution margin as a label. Okay, so it should be here. There it is. Contribution margin. Not the ratio, but the margin. Okay, so we're putting that in now. And now we're ready to put in a label that's going to identify the fixed costs. So go find a label that says fixed costs up here. There it is. Okay, so where it says label, put in a label. Where it says description amount, put in a description amount. Okay, so that's just going to say fixed costs. So now we're going to go find an amount. The fixed cost amounts that we extract in order to get this variable costing is the fixed manufacturing overhead and the fixed selling and admin. So let's go get these amount descriptions. Okay, so we have fixed manufacturing costs, and there's the other one we'll need. Okay, so I'm getting one at a time and bringing it in. Okay, and now we want the fixed selling and admin amount description. Okay, fixed selling and admin. Bring it down. And then we're going to do a total of all of the fixed costs. So this is an amount description where we add up the fixed costs together. Okay, so let's go get total fixed costs. We're almost done with the labels. This should help, right? So then when we get down here, we need operating income, okay? And we're going to expect these operating incomes to be different because we have different production units versus sales, all right? So now all we need is the amount description. You can type it in. Should be operating income, okay? Let's see if we've got our labels right, okay? Make sure you got your labels in right. That's worth doing. Okay, here's where we start to figure out how much the variable costs are going to be. So, variable costs, if you look up here, the variable costs, back up here, if you add up direct materials, direct labor, and variable manufacturing overhead, if you add up those three, you're going to find out that they're $40.50 a unit. And I've got $40.50 a unit right here next to that. We're going to take that times the number we produced, okay? So you're going to have a lesser amount of variable cost of goods manufactured is going to be less than fixed. Here's the absorption amount, the 9,157,000, but we're taking out the fixed. So when you remove the fixed, it adds up to 6,682,500. That should be these three totals also. So you could do it that way too if you want. Okay. But then we've got that 15,000 that we have to separate out. And there's a cost for that. Okay. So those 15,000 need to be taken times that $40.50. Okay. So let's put these numbers in. Now remember, the amount we put in for the cost of goods manufactured is all of the costs. And we're going to put in just the variable costs. So the variable costs for what we manufactured, which is 165,000 units, is 6,682,500. Okay. And right, so right beside it, I'm going to put how I got that number. Okay. So you know, I took 165,000 units produced times, okay, that $40.50 a unit that I found by just using the variable costs. Okay, so that's going to be beside this, so you know where I got this at. Okay, and then we're going to turn around and do 15,000 units. Okay, let me make sure I'm right. Okay, so I got, yep. Okay, so we're going to subtract the 15,000 units that are still in ending inventory. Okay, so we got 15,000 units that's still in ending inventory because we only sold 150,000. We got to take that times the $40.50 each. Okay. $40.50 each. And that's going to get us the amount that's still in inventory that's going to get subtracted from this variable cost of goods manufactured. Okay. So we've got our amount of variable cost of goods manufactured. It's 165,000 units that we produced times just the variable cost per unit. Then we're going to put in the amount for the inventory. We take 15,000 units. It's still in inventory times the variable cost of $40.50. And I got 607,500. You need to subtract that. That has to be a subtraction. Okay, because this amount is not in cost of goods sold yet. Okay, so be sure to subtract. And I think that's probably going to be one of the hardest things to remember if we need to. But if you put it in the spreadsheet here, this is my new amount. Okay, so my total variable costs of the goods that are sold is $6,075,000. Okay, and that is subtracting that inventory amount. Okay, in finished goods that's still there from the cost of the goods manufactured. Okay, now we're ready for our first subtotal. We're going to subtract the total variable cost of goods sold from the sales. Okay, and we're going to get our first subtotal. Okay, I got 5,175,000 as my manufacturing margin. Okay, I'm going to see if I get right answers or not. You might double check that you've got that, okay? Then we're gonna go get the variable selling and admin expenses, so we kind of have to do what we did here. So if you look at 450,450, so if you go up here and look, and let me see where I'm at here. Okay, so these are based on the number of units produced. Okay, so the variable selling, one more time. If you take your variable selling here and divide it by 165, you get $2.73 per unit, $2.73. So that should be, let me make sure. I've got that as times C176. So, boy, this is really, yeah. All right. So let me see if this amount is going to work. Okay, so we want to put these variable expenses in. So if my math is correct here, which I got 450,450 because we're producing more, okay? So let me put this in and see if it's right. If it's not, then I need to fix it. Okay, so I'm going to put this amount in and see if I'm right. If it's wrong, okay, it is wrong, okay? So hang on a minute. So what we need to do is put in the variable amount, right? The variable amount is 450,000. So just put that in there, okay? Just key in 450,000 as your variable selling and admin, okay? So that's what I'm going to do here. I'm going to get rid of, I got 450,000. That is the variable amount, and that is the right amount. So somehow my calculations got off when I was doing this, so I'm going to key this in, 450,000. Okay, so now my contribution margin is the difference between the manufacturing margin and the variable selling and admin. Okay, so you just do the math here, and my contribution margin is 4,725,000 as the contribution margin. Okay, so you didn't have to figure out this per amount at all. You didn't need to figure that out. You just put in what the variable selling and admin is. Okay, now we're going to put in the fixed. Okay, here come the fixed. So the fixed are the same fixed as what we put in up here. Okay, so whatever they've broken them out into, here's your fixed of your manufacturing overhead. Here's your fixed of your selling and admin. So I'm going to put these numbers in. I got 2,475,000, and my fixed selling and admin is 1,125,000. So I'm going to put these in, okay? Because fixed don't change based on what we've been told. Okay, now we want to total both of those together. When I total mine, I get 3,600,000. Okay, and I'm going to subtract that from the contribution margin. The contribution margin is 1,125,000. Okay, that's what I got. So it looks like it's okay. Okay, so let's see. Now I've recapped my stuff right here in the spreadsheet. So one more time to see if our rule holds true. So back here, the rule says that if the number produced is higher than the number sold, then our variable income should be lower than our absorption income, okay? So one more time, here is our variable income. Here is our absorption income. So it is true, okay? It's true, but we need to understand. So since production units are larger than units sold, the absorption costing income is going to be larger than the variable costing income, all right? So let's see if we can put these information in. So the operating income reported under what? The operating income reported under absorption costing exceeds the operating income reported under variable costing. Yes, that's true. And this is due to the fixed manufacturing costs that are deferred to a future month under variable costing. Okay, so see, I picked the wrong one, under absorption costing. Okay, so here you go, one more time. So the operating income reported in our absorption income statement was $1,350,000. And then when we rearrange things and put it in here differently, the operating income is actually $1,125,000 because we segregated out the fixed manufacturing costs out of up here. Okay, so the only manufacturing costs in the variable costing is ones that vary, right? Okay, so due to fixed manufacturing costs that are deferred to a future month under absorption costing, okay? So when that gets separated out, that's why you're getting different incomes. And believe it or not, that is the end. And that is really complicated, what we've just been through. I think this is more complicated than I remember taking cost accounting, probably at Wichita State. Yeah, so I'm like, whoa. So I promise you that I will make sure that you know what kind of problems you'll have on the test about this, okay? Because this is pretty challenging, okay? And Daniel, you have the patience of Job. So I appreciate you hanging in there. Did you get your numbers?
Yes, I did.
And if you didn't, all you have to do is tell me and we'll figure them out for you.
I appreciate that. I did get them.
Man, you are. I don't think I could have followed this sitting out here. I just don't think so.
I am definitely ready to go home.
Amen. You stayed about an extra hour.
Yeah.
Yeah.
It is worth it though.
Well,
I don't like to do those long problems.
man, I didn't realize how long some of these were. And so I'm gonna go for now, guys. I think everybody's probably cleared off of here anyway. No, Ruby, you're still there. Wow. Patience of Job. Okay. So I'm going to stop recording so that I can now put the recording on, which is going to be heck. So let me stop recording so that, and then we'll say goodbye for now. All right. Hang in there. We'll see you on the next video.